Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Irhythm Holdings Inc. Annual Report. Irhythm Holdings Inc., a digital healthcare company, offers a range of device-based technology services for diagnosing arrhythmias in the United States. The company's primary service is its Zio ambulatory cardiac monitoring services, which include long-term and short-term continuous monitoring, as well as mobile cardiac telemetry monitoring. In addition to these services, Irhythm Holdings provides several prescription-only remote electrocardiogram (ECG) monitoring systems. These include the Zio Monitor System, the Zio XT System, and the Zio AT System, all of which consist of a patch ECG monitor that records the electric signal from the heart continuously for up to 14 days. The company also offers the Zio ECG Utilization Software System, which supports the capture and analysis of ECG data. Furthermore, Irhythm Holdings has a development collaboration agreement with Verily Life Sciences LLC and Verity Ireland, limited to develop next-generation atrial fibrillation screening, detection, or monitoring products. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause an increase in stock price for Irhythm Holdings, Inc. Irhythm Holdings, Inc., a medical technology company specializing in cardiac monitoring and diagnostic solutions, has seen its stock price rise significantly over the past year. Several factors have contributed to this upward trend. Firstly, the growing demand for remote patient monitoring services has driven the adoption of Irhythm's products, particularly its flagship device, the Zio XT patch. The increasing prevalence of cardiovascular diseases worldwide has also led to a surge in demand for diagnostic solutions like those offered by Irhythm. As healthcare providers seek more efficient and cost-effective ways to diagnose and manage cardiac conditions, companies like Irhythm are well-positioned to capitalize on this trend. Additionally, Irhythm's focus on developing innovative technologies that improve patient outcomes and reduce healthcare costs has resonated with investors. The company's commitment to research and development has led to the creation of new products and services that address emerging needs in the market. Furthermore, Irhythm's partnerships with major healthcare organizations have expanded its reach and credibility within the industry. These collaborations have enabled the company to integrate its solutions into existing workflows, making it easier for providers to adopt its technology. Lastly, the overall growth prospects of the medical technology sector have contributed to Irhythm's stock price increase. As investors become more optimistic about the long-term potential of companies in this space, they are willing to pay a premium for shares in companies like Irhythm that are poised for continued growth and expansion. Irhythm Holdings, Inc. market capitalization of $5 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Irhythm Holdings, Inc. holds a significant advantage in their industry. Irhythm Holdings, Inc. trades at a higher price-to-book ratio of 39.47 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 90% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company are multifaceted. On the growth side, contracted third-party payers, CMS reimbursement rates, and healthcare institutions have been significant contributors to increased revenue. The negotiation of prices for services has led to substantial increases in 2025, while changes to CPT codes and reimbursement rates set by CMS also impact revenue. In contrast, denied claims, uncollectible patient accounts receivable, and implicit price concessions are key drivers of revenue decline. Variable consideration for denied claims can significantly reduce revenue, as can bad debt expense resulting from uncollectible accounts. Concessions made for non-contracted portfolios also contribute to reduced revenue. Industry and market trends, such as macroeconomic factors, reimbursement rates, and third-party payer behavior, further influence the company's revenue growth or decline. The impact of these external factors on revenue can be significant, making it essential for the company to stay adaptable and responsive to changing conditions. The net income of the company has experienced a decline over the years due to various reasons. Initially, on page 28, it decreased due to uncertainty in billing and collection processes, potential write-offs, and growth in patient responsibility accounts. This trend continued with another decrease on page 37, attributed to compliance risks associated with new regulations. The net income turned negative in 2024 and 2025, indicating a significant decline. The profit margins of the company have also decreased over time. On page 28, it was due to decreased revenue and increased costs from implementing compliance procedures. This trend may be exacerbated by dependence on third-party vendors, cybersecurity requirements, AI regulation, and key personnel turnover. The company expects to continue incurring operating losses, indicating a persistent decline in profit margins. The reasons for these changes are multifaceted. Uncertainty in billing and collection processes has been a significant contributor to the decline in net income. Compliance risks associated with new regulations have also played a role. Additionally, macroeconomic factors such as inflationary pressure, supply chain disruptions, and uncertain demand have impacted the company's financial performance. These factors have cumulatively led to a decline in both net income and profit margins. The company's financial performance has shown a significant improvement in generating positive operating cash flow. A comparison of the net cash provided by operating activities for 2024 and 2025 reveals a substantial increase from $3,390,000 to $80,863,000. This indicates that the company is now able to generate sufficient cash from its core operations to meet its financial obligations and invest in growth opportunities. The significant jump in operating cash flow suggests that the company's business model is becoming more efficient and profitable, setting a positive trend for future financial performance. The company's debt level has undergone significant changes over the past 2 years. In 2024, the company borrowed a substantial amount of $661.3 million, leading to an increase in total liabilities from $840,541 to $867,296 by 2025. However, the principal amount of senior convertible notes due in 2029 remains stable at $661,250,000. In terms of interest expenses, there has been a slight fluctuation over the years. In 2023 and 2024, interest expenses were $13,154,000 and $12,821,000 respectively. Notably, interest expenses remained unchanged in 2025 at $13,154,000. However, the amortization of debt discount increased from $2,796 in 2024 to $3,060 in 2025. Additionally, the total interest expense recognized on senior convertible notes due in 2029 increased from $10,883,000 in 2024 to $13,117,000 in 2025. Overall, while there have been some changes in debt level and interest expenses, they are not drastic. The company's borrowing activities have led to an increase in total liabilities, but the principal amount of senior convertible notes remains stable. The financial performance of the Medicare program was a notable highlight, contributing significantly to the company's total revenue at 24%. This achievement underscores the program's efficiency and effectiveness in meeting its objectives. On the other hand, certain regions pose potential challenges for the company. The Philippines, EU, specifically UK and Switzerland, and Japan are identified as areas where difficulties may arise. The management of the company is optimistic about its outlook and strategy. The The company is experiencing growth in commercial volumes and is investing in strategic loan investments and equity investments to support this growth. A key focus area for the company is its ambulatory cardiac monitoring (ACM) business, which involves designing, developing, and commercializing device-based technology for ambulatory cardiac monitoring services. The company is also prioritizing revenue growth, with a reduction in net loss due to this growth. To achieve this goal, the company is continuously reviewing its liquidity and anticipated capital requirements, ensuring it has adequate liquidity over the next 12 months. Additionally, the company is adapting its business to navigate macroeconomic uncertainty, including inflation, interest rate volatility, and potential instability in the global banking system. The management strategy also involves investing in research and development (R&D) to develop new products and services, such as clinical-grade wearables to detect and characterize arrhythmias. Furthermore, the company has entered into a technology license agreement with BioIS to develop and commercialize new products and services, including pulse oximetry and unattended diagnostic testing. Overall, the management's outlook is focused on growth, expansion, and revenue growth, while also adapting to macroeconomic uncertainty and managing its cash requirements. The company has made several strategic acquisitions and investments to drive growth and innovation. In terms of acquisitions, the company has purchased licensed technologies from BioIS for $20.4 million, contingent on future milestones. Additionally, it has invested $55 million in a strategic loan to BioIntelliSense, Inc., as well as smaller investments in other privately held companies. The company has also made significant divestitures, including the termination of its development collaboration agreement with Verily, resulting in payments totaling $11 million. Furthermore, it has subleased half of its San Francisco facility and canceled milestone notes worth $10 million plus accrued interest as part of the agreement's termination. These transactions demonstrate the company's efforts to optimize its resources and focus on key areas of growth. The company's financial policies are transparent and clearly stated. According to the information available, the company has chosen not to pay dividends to its shareholders. This decision suggests that the company is prioritizing reinvesting profits into its operations or using them for other business purposes. There is no mention of share buybacks in the provided text, leaving this aspect of the company's financial strategy unclear. However, it can be inferred that the company's focus on growth and expansion may be a contributing factor to their decision not to engage in share buybacks. Concerns about inventory buildup and supply chain disruption are prevalent throughout the report. Inventory buildup is a significant concern, with total inventory increasing by 54% from $14,039,000 in 2024 to $21,634,000 in 2025. This increase raises questions about the company's ability to manage its inventory levels effectively. Supply chain disruptions also pose a significant threat to the company's operations and financial results. The report highlights various risks, including shortages of key components, strain on suppliers due to economic downturn, and compliance with regulations such as the BIOSECURE Act. Additionally, single-source vendors for critical components and materials may cause considerable delays in finding alternative sources of supply. The potential impact of supply chain disruptions is far-reaching, affecting not only the company's operations but also its financial results. The report mentions that hospitals are experiencing staffing shortages and supply chain issues that could affect their ability to provide patient care. Tariffs on imports are also mentioned as a potential macroeconomic factor, contributing to delays in payments of outstanding receivables and supply chain disruptions. Overall, the concerns about inventory buildup and supply chain disruption are multifaceted and interconnected. The company must address these risks proactively to ensure its continued success and competitiveness in the market. That concludes the financial summary for Irhythm Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.